Accounting Adjustments Problem 4. Potato Inc. experienced the following 3 events in year 1. Performed services for $16,500 cash. Purchased $6,200 of supplies on account, and took a physical count of supplies on December 31st, year 1 and found that there was $1,260 of supplies on hand. Complete and calculate the following. Record events using the accounting equation. Prepare the balance sheet, income statement, and statement of cash flows. Determine the balance in supplies as of January 1st, year 2, and determine the balance in supplies expense as of January 1st, year 2. Whenever we have a list of items like this, it always helps just to start off by going through the accounting equation. We've got 3 transactions, A, B, and C. Let's go ahead, set up our accounting equation. Assets equals liabilities plus equity. Go through each of these. Now I'm going to tell you that the assets involved here, we have cash and supplies, as the problem states, lots of supplies. Liabilities, we have accounts payable. And yes, I know that this is a corporation, but for this one, we're just going to focus on the retained earnings. Now, if we do have retained earnings, I'll specify which type of account is involved. Just 3 transactions. Transaction A, perform services for $16,500 cash. Cash goes up, $16,500. Any supplies? No. Any accounts payable? No. What about retained earnings? Yes, we have an increase in retained earnings by $16,500. How? Because it's revenue. Revenue increases retained earnings, so we'll note it's revenue. And the equation balances. Let's go to B. Purchased $6,200 of supplies on account. Anytime you see the phrase on account, accounts payable, accounts receivable. Here, it's an outflow, so it's going to be accounts payable. Cash, nothing. Nothing changes cash because we're not paying with cash. Supplies go up by $6,200. Accounts payable goes up by $6,200 because we're borrowing, and there's no effect to retained earnings. Transaction C. We're told, took a physical count of supplies on December 31st, the end of the year, and found there was $1,260 of supplies on hand. All right. So we need to think about what's going on here. The supplies on hand are $1,260 at the end of the year. We're doing the accounting equation. So they're telling us the balance in supplies. Remember, we do the balance. After we do the accounting equation, we calculate the balance. We calculate the balance in all of these items. Cash, supplies, accounts payable, retained earnings. It's telling us the balance in supplies should be $1,260. That means we need to back out the amount there. So obviously, if we go from $6,200 to $1,260, and these are the only transactions, we know that it's going to decrease. It's going to decrease. So we take $6,200 minus $1,260. We're going to get $4,940 decrease in supplies. Now, if supplies go down and you haven't sold them, how else can they decrease? We can use them. Remember, supplies are an example of a prepaid expense. They are a prepaid expense. We buy 1 million sheets of paper. When we use up some of that paper, it's no longer a current or future resource, and at the end of the accounting period, we have to adjust it by expensing the supplies. So we expense the supplies, and the expense reduces retained earnings by the same $4,940. So we can go ahead and we can now fill in reduction $4,940. That's $4,940. So we've just done the accounting equation. We'll get our balances. Our balance in cash is $16,500. We get our accounts payable balance, which is $6,200. We get our retained earnings balance, which is $11,560. We determine the balances, we add them up, and you'll see that they do balance. They do balance, the left equals the right. Now that we have this information, we can now go through our different statements and determine what we need. To make some room, I'm going to erase the prepaid expense portion. So let's go ahead and do that. Now, since we have our accounting equation, we can go ahead, we can calculate, and we can display these different items. We've recorded the events using the accounting equation. Now we need to prepare a balance sheet, income statement, statement of cash flows. Let's start with the easiest of those, and of course the one that's the one you should do before the others. We have the income statement. Income statement just is revenue minus expenses. That's all we're going to do there. Revenue minus expenses. That gives us net income if it's negative net loss. Our revenue here, we saw in the first transaction, is $16,500. Expenses we saw in the transaction C is $49.40, so we'll subtract away $49.40. And we're going to get net income of $11,560. So that is the income statement. Easy, very easy. Now let's do our balance sheet. Balance sheet, we've got assets on the left. Let's do this right here. Assets. And then we have liabilities and stockholders' equity or owner's equity on the right. Now, yes, this problem is a corporation. It's Potato Inc. As I said earlier, we're just going to do retained earnings. We're not going to focus on the stockholders' equity. So the assets here, we have cash and we have supplies. The cash amount, we just look at the balance, $16,500. Supplies, we look at the balance at the end. It actually told us $1,260. Add those together, only assets, we get total assets of $17,760. Our liabilities, we have accounts payable. Going back to our accounting equation, we have accounts payable. And the amount of accounts payable from our balance is $6,200. Stockholders' equities have retained earnings. Our balance there is $11,560. We add those two numbers, we get $17,760, and our balance sheet equals. So we're going to separate that. So that was our balance sheet. And our income statement already. Now we're going to move on to our statement of cash flows. When we do the statement of cash flows using our accounting equation, all you have to do is focus on the cash column. Focus on the cash column. We've only got one item. Item A. That's it. Just one item. And that's going to be from transaction A, perform services for $16,500 cash. That resulted in net revenue. And remember, revenues, expenses, net income, that goes under operating activities. So our statement of cash flows, let's write that out. Remember, we have operating, investing, and financing activities. We're only going to have one item. It's going to be under operating activities. Operating activities, cash receipt from revenue, and the amount is $16,500 positive, right? Because we have an inflow in cash. There's no investing, there's no financing, those are both zero. So that means our change in the statement of cash flows is $16,500, our net change, right? Our investing activity is zero. Financing activity is zero. So our net change in cash is $16,500. We have to add our beginning balance in cash, which we're not told. So it's zero. So our ending balance in cash, just from these transactions, is $16,500. And we've completed our statement of cash flows. Boom, like that. Income statement, balance sheet, statement of cash flows. We've completed all three of those pretty quick. So going back to our questions, we've recorded the events using the accounting equation, so we can cross that off. We prepared the balance sheet, the income statement, statement of cash flows, so we can eliminate those, write those off. We've got two items left. Balance in supplies as of January 1st, year 2, and balance in supplies as of January 1st, year 2. Now in this question, we were determining things at the end of the year, 12/31, year 1. That was what everything was. The income statement, the balance sheet, statement of cash flows, and the accounting equation. These questions ask for next year, year 2. Year 2. Now remember one thing. End of the year rolls over to next year for balance sheet accounts, which are known as permanent accounts. So anything that's on the balance sheet will roll over. This is balance sheet for 12/31, year 1. This will also be what you see in the balance sheet, the beginning of next year, 1/1, year 2, the very beginning, right before the day begins. So our supplies, if it's asking for balance and supplies as of January 1st, year 2, that's going to be $1,260. the same 1260. The balance in supplies expense as of January 1st, year 2, that's going to be 0 because expense is not a permanent account. It's a temporary account. At the end of next year, yes, our supplies expense this year was $49.40, right, in year 1, but year 2, beginning of the year, will be 0. So this will be balance of supplies as of January 1st, year 2. This will be $12.60. And then the balance of supplies expense as of January 1st, year 2 will be 0 because it's a temporary account.